Good evening, everyone, and thank you so much for joining on our latest webinar. I'll quickly, as we always do, take you through a quick update on the firm and the performance of our products. And then we will get down to discussing our latest fine print report on office leasing and the various commercial real estate models that we've evaluated. We'll conclude the call with a quick Q&A. Without any further ado, let me start with the quick update on the firm and the performance. Most importantly, in terms of the team, happy to share that there were three new additions during the past quarter. And as you would see, in terms of both the research as well as the non-investment team, there is full stability in terms of the personnel. And what we've also been able to do over the past quarter, thankfully, is add the right candidates as we grow our size and operations as a firm. So that is the key message that consistently tallies with what we are saying earlier also, that the core team is in place and we are incrementally, as and when the need arises, adding more and more people to be able to ensure portfolios are managed and client experience and servicing is of the highest standards. So that's the quick update on the team. Uh, Post that, let me quickly move over to our two products and let me start up with FAIR, which is our FlexiCap strategy. This is the performance of FAIR on a since inception basis. I'm pleased to share that FAIR has now crossed 1.5 years of performance. We started in April 2024, and this performance is as on October end, so 1.5 years. Again, if you see consistently, the strategy continues to deliver outperformance of roughly between 400 to 500 basis points. As on October end, we were 4.4% outperformance compared to our benchmark, which is BSE 500 TRI. And while these numbers look impressive, the other thing to note is the last 1.5 years have been particularly challenging for the broader market. And I think we should see this performance in context of that as well. If you see the overall portfolio composition, FAIR has about a 45% allocation to mid and small caps, compared to about 20-25% in the benchmark. So despite that and despite this challenging environment over the last 1.5 years, FAIR continues to outperform broader indices by about 400 to 500 basis points. So that's the quick update on FAIR. I'll quickly move over to Fiber, which is our thematic portfolio. Again, very pleased to share that Fiber is outperforming its right benchmark, which is BSE small cap, because two-thirds of the portfolio is actually small caps if you look at the portfolio composition. Again, if you compare on a since inception basis, Fiber is outperforming by another 400 basis points. So at 5.4% IRR since inception, the small cap comparison performance is about 1.3%. So again, you see a very similar trend in terms of outperformance of about 400 basis points on a since inception basis. And again, we continue to add capital, we continue to build track record over time, but it's heartening to see that the trends and the target that we had of ensuring client alpha is maintained is being met on a consistent basis. So that is the quick update on the two strategies. Happy to take any questions when we come to our Q&A section. The other quick update that I wanted to share is in terms of our product ideas. So in addition to FAIR and Fiber, I'm pleased to share that there is another very interesting product that we have recently launched. And I thought I'll take this opportunity to spend a couple of minutes on that. The genesis of this new idea comes from the clear activity that we've been seeing in the IPO market over the last few years. And if you recollect, we had mentioned this at the start when we did our annual outlook in January. And we continue to track this, and it makes for very interesting reading if you look at it. We are clearly seeing a trend where IPOs are becoming more and more mainstream in terms of their sizes. And this was a stat which I thought I will leave the audience with, which when we did the numbers really surprised us. If you see the IPO activity, and this is particularly the period from 2021 to 25, the last 4 years, if you cumulate those IPOs and look at the market cap compared to the overall market cap in India today, the IPOs in the last 4 years contribute 13.4% of the total market cap of India. And that makes for a very powerful data point for us to understand. So, and like we said at the start, when we started off, we still maintain that view that this is not the year of the IPO, but the decade of the IPO. I think this deepening of capital markets with new and new sectors, new and new players, and new companies coming to IPO will continue. We are seeing that continue as we speak, and we expect this to sustain. What this does is throws upon very interesting pre-IPO opportunities. And that is what we are trying to address through our third new product, which is called Full. Full stands for Fident, Unlisted and Listed Large Value PMS. Through Full, what we are trying to do, and I'll just take you through a nutshell and happy to discuss this in further detail depending on queries and interest. But what we are trying to do through Full is basically it's a large value PMS designed for accredited investors. And this is a recent regulation that SEBI has introduced of how investors can accredit themselves and what are the criteria for being an accredited investor. This is again something that we facilitate for all investors if they are eligible, and we guide them on the entire process and journey of accreditation and also track their accreditation. What this does is for accredited investors who choose to and who can invest in the large value PMS category, it gives them the ability to access both pre-IPO as well as listed opportunities. So of course, on the listed side, as you are aware, we have two products with existing track record. Both those products can be invested into. But in addition, you can also access pre-IPO opportunities that we will closely work on and showcase to you on an ongoing basis. The next question that will come in anybody's mind is, how is this different from the other pre-IPO opportunities that you are seeing from a lot of other securities firms, wealth managers alike? I think the difference that we bring is in terms of bringing you not only opportunities, but also enabling you with the coverage, the research, as well as build a framework to monitor and facilitate exits if the need may be. So that I think is a big gap in the market today. You see plenty of pre-IPO opportunities coming, but what we also add is the ability to go the extra distance, use our research strength, give you coverage on the same, and then keep monitoring those portfolios. Given the fact that we are managing both listed and pre-IPO within a single product, it also gives us the ability to manage asset allocation between these two asset classes. So that is also a key ingredient of Full. And I think the last two products are common and constant for any product or strategy that we will introduce. We will always see a high level of alignment through all our strategies. And just like we did for Fair and Fiber, the first set of investors for Full are also us and employees and friends and family. So that recipe and that construct is intact. I'm pleased to share that we have now 6 operational Full investors, 6 large value PMS accounts which have already been opened. And that is the reason post which we wanted to showcase this idea to a larger audience. So we ensure that every opportunity on the public or the private side will have a high level of alignment. There will be investment of the firm or the key people working on the opportunity. And only then it will pass the muster in terms of being showcased to you. What also has happened over the last 1.5 years is it's also helped us showcase our capabilities, both on private equity as well as on public equity. So for public equity, of course, you saw the track record of both our strategies. We've done fairly decent on the private opportunities as well. And again, in the interest of time, I'm not going through trade by trade in terms of the IRRs of the trade, but again, happy to deep dive on that if there are any queries. So what we are doing in summary is through this large value PMS, creating a framework for investors to work and identify and allocate to both listed and pre-IPO opportunities. And the good part is because this is large value, the minimum investment size is 10 crores. And what that also does is gives us the ability to engage with investors and create tailor-made portfolios. So there is no standard portfolio that we need to stick to. It's a function of the opportunities available at the point in time, the risk appetite of the investor, and our engagement and how that evolves. So that was one product idea which I thought I'll quickly leave you with. With this, I'll quickly move over to the core agenda for the day, which is on flexible workspaces. And just to refresh memory, this is a report that we come up periodically on various themes and opportunities that we keep seeing. So if you recollect, if I take you back in time, 3 months back, we had done a similar webinar on the GLP-1 and the CDMO opportunity. And we had also showcased few high conviction ideas in that segment, which we had introduced in our portfolios. And I'm hoping all of you would have noted that, and both those ideas have done exceedingly well in our portfolios and helped contribute to the alpha as well. So in that same way, we wanted to take you through the commercial real estate market and why we see value in flexible workspaces. So that is what we wanted to cover next. And with this, I'll hand over to Ashwarya to take you through the opportunity.
Thank you, Bhavin. Good evening, all the viewers. So, this is our second edition of Fident Fineprint, where we have covered. The idea is to basically cover themes or trends which we believe are pretty new to the industry or which have a higher probability of creating alpha for the market. One such area which has been very close to the economy, basically is more of an old school economy, is commercial real estate. And historically, what has happened in that particular space that you have a limited way of playing it through developers. But when we went deeper, we realized that there are various other ways of playing, this whole thesis, whether it is in the form of hotels, malls, cinemas, and the most interesting of them is REITs. But there is one new trend which is building up in the commercial real estate is basically your flexi leasing. And our idea is to cover that aspects in detail for you to understand where is the opportunity and where investors can put their money to work on. The one area which we are very clear at Fident is that we always want to focus on businesses which are strong capital allocators, cash flow throwers, and which are run by competent management. So this goes without saying when we deep dive into any of these businesses. Now, if you see, as I spoke, there are like various ways of playing, commercial real estate. And historically, if you see that majority of them investment has happened to either hotels, malls, cinemas. And we will quickly touch base on each one of them to understand what's happening in that sector before we move on to this new trend of flex leasing. So directly moving to hotels, if you see the last 4 5 years has been very, I would say, healthy for hotel as a sector, right? The current, if you see in 2025, they are close to 200,000 rooms. And the two things which really matters in hotels as a sector is basically the occupancy and ADR, which is an average revenue room per room that the hotel get. So right now, majority of these occupancies of this hotel of 200,000 is between 65 to 70%, which we believe is very, very healthy. And not only that, if you see the average room rate has inched up from almost 5,500, 6,000 to almost 7,500, 8,000 in the last, say, 4 5 years. So hotel, if you see the last 20 years cycle, hotel sector has done phenomenally well from 2007 till 11 12, where the majority of the capex came in the form of new rooms. But from 2012 till 2020, it was a very, very lag period. Not only the occupancy went as below as 45 50%, but the average room rate didn't grow more than 1 or 2% in the 6 7 years. And majority of them, of the hotel companies, has not done well. Their EPS growth was negative or flattish or high single digit. And the wealth was not created. And then post COVID, we realized this that there was a kind of a revenge travel. There was strong travel rebound, and majority of the balance sheet which was struggling from 2012 till 20 deleveraged, and they found two important things. One was the growth and the strong leverage, and we saw majority of the hotel stock did really well from 2020 to 23 24 and even till today. But what lies in future, we understand that there is huge capacity which is coming up now. There's almost 100,000 keys which will be added over the next 4 years on already a base of 200,000 keys. So there will be a kind of a supply glut. And we have always seen it as a cycle. It's a long-term cycle which will play out. There is a trend which is evolving in hotels that a lot of these companies are now focusing on asset-light management contracts rather than owning and leasing out, which was an old school way of doing it. So some of these hotels are doing that thing on asset light. possibly they can still maintain their growth. But because of this supply glut, we believe the pressure on occupancy and their average room rate growth will be felt in the couple of years in the coming time frame. And we believe, that valuation at this juncture is not justifying opportunity in this space. So that's why overall we are staying more or less away from hotels at Fident in this commercial real estate pie. Now, moving to the second segment, which is malls, and we are very positive on consumer discretionary, and we believe that there is an inherent traction or the demand inertia which is building up in that space. But when we go deeper into the malls as a landscape, there are roughly around 340 odd operational mall in the country across 29 countries, which include tier 1 and tier 2. And majority of them are concentrated in tier 1 cities. So almost 75% of them, more than 270, 260 malls are there in tier 1 cities. And if we see the scenario here in the evolution of the industry in pre-COVID and post-COVID, the capacity addition has happened, but it has been pretty gradual. So if we see the period from 2010 till 2020, when things were just growing up from economic wise and the real estate wise, the growth in that mall as a space was always either mid single digit or high single digit. They have never crossed double digit growth on a long term time period. And because of this heavy investments, of the ROC of the malls historically has been low single digit, 8, 7, 8%, 9% at max. Even if you go deeper, there are some companies which have been able to crack the code and like play like Phoenix and all who have been able to put up a good show, but they're also struggling with generating return ratios. Even if you see last 4 5 years, the location in malls is very, very crucial. There are almost some 40 45 malls which have closed in the last 4 years, which includes tier 1. So there are a lot of ghost malls which are there. And unfortunately, many of those companies are facing that kind of investment in their portfolio. The return ratios can literally go to low digit of 4 5%. So investment in malls through this commercial real estate is a very, very tricky one. One have to be very sure about you buy a piece where all the ticks are there about locations, return ratios, and growth. Even a company like Phoenix, which we believe is one of the best in the space, post 2020, there was the growth of 5 7% in the mall category went up to almost 15 to 17%. So there was an almost two and a half times increment in growth because of the K-shaped recovery and the rebounding in the footfalls. But we didn't see improvement in ROC. ROC is still at almost 8 9%, 10% for there. So for there, in that perspective, making money becomes difficult. And even many of these companies which used to trade between 8 to 10 times EV/EBITDA before COVID, because of the growth, the valuation has gone up to almost 20 25 times EV/EBITDA. So the valuation comfort is very, very limited in that companies which are primarily into malls. So that's why we are also avoiding mall as a space in the commercial real estate. Now, moving to the most exciting one where there has been a lot of consolidation which has happened is cinema. And if I give you just a brief summary of the sector, there are roughly 9,500 odd screen in the country, which include both singles and multiplexes. Roughly 4,000 are multiplexes out of 9,500. And in this 4,000, if you see around 50% of the market share is between PVR Inox and Cinepolis. So there is a huge concentration which has actually played out in the last 3 4 years in the industry. And there is two things which has also played out is the average ticket prices have also increased in the last 4 5 years, and as well as the F&B growth has gone up almost 8 9% in the last 4 5 years. Every things which you want in a sector, higher revenue growth, higher pricing power, consolidation has actually plays out in this particular space. But not much money has been made in that. So you have limited investment opportunity. One is obviously PVR, other are unlisted. So one important data one which we want to bring to everybody's notice, if you see that one area which this particular segment is struggling with is occupancies. And if you see this very important table in front of you, if you see before 20, before COVID, occupancy used to be around anywhere between 30% to 40% range. Average was around 35, 37%. And occupancy is very, very critical here because there's a huge operating leverage. There's a lot of fixed cost which is there. And higher the footfall, your ability to be profitable increases manifold. But if you see post-COVID, possibly because of OTT platforms, and to some extent we can say the quality of content was also not all that great, occupancy has been falling. There was some initial fall from 37 to almost, if you can see, almost 21, 22% in FY 22. But there's not been much rebound since then. So what has been the resultant scenario is that these portfolios of companies, they have not been able to create or generate higher return ratios. Even the new skin addition has been muted over the last 4 or 5 years. There has been not much of expansion, but then it makes it a very, very tricky call for investors to go ahead and put money there, in spite of all the right things which are playing out. So we believe the only way when cinemas can really make meaningful wealth for the investors is with the rising occupancies. And that is more of a macro call to take whether human beings or Indians will like to go more and watch cinema, or whether they will have a mixed bag of watching cinema at home and doing OTT as a mix. If the trend of below 20% goes through or close to 20%, then it's become very, very difficult for these companies to generate higher return ratios. And we understand the industry is also moving toward light contract and things like that. So we believe there's a kind of a difficulty to play out in this, and that's why we are categorically staying away from cinema in our portfolio. Now, on to the next one. Before we move on to the flexi leasing, which we believe is an interesting area, this concept of REITs, we believe, will be the next big thing. Globally, it is one of the big investment avenue. In India, it is still haven't grown up, but there is a huge tailwind which will make it work, right? So if you see, SEBI gave them the clarification and consent in 2014. I think the embassy was the first one which came listed in REITs. So REITs, for everybody's comfort, is a kind of a trust which is listed, which manages real estate, primarily commercial or retail, take all of the cash flows in an SPV format and give it to the investors. So raise money from the investors, put that money and invest into real estate, manage those assets, get the yields, and just pass it the cash flows to the investor and try to manage almost anywhere between 9% to 11%, 12% kind of a yield. So if you see, the majority of the REITs are listed. Embassy was the first one, which primarily do commercial real estate, which is the largest one in the country, followed by Mindspace, which is also an official commercial real estate, and Brookfield and Access also do some sort of retail part. The understanding of REITs is very, very important. So REITs is basically where they're managing close to 1.63 lakh crore of asset, which we believe is peanuts compared to the big commercial real estate opportunity which is there in the country. They are hardly occupying around 10 or 15% of the India Grade A office inventory in the top 6 to 8 cities. So the pipeline is huge. If you go and see the pyramid part, the opportunity is huge there. And SEBI has classified REITs as an equity, so it become investable into areas of these mutual funds and other investment management asset management companies there. Now we have to understand certain area of if somebody want to invest in REITs. First is, SEBI came out with two important, regulation. One is that any REIT listed player can only invest up to 20% or more in underdeveloped opportunities in high grade commercial real estate. So 80% has to be there in completed. So that leaves out higher yield generating capabilities for assets which can really get at a lower price, lower capex, and your yields can go higher. Obviously, this is to mitigate risk, but that limits the yield generation capability of REITs there. Second is that they have to pay out 90% of their distributed cash flows, to the investors. So every time if you are owning an asset and you're paying out 90% for your growth, you have to keep either borrowing or raising more money. That again hits your ability to generate returns and ROEs and things like that. So all of this has obviously risk averse measures, but then it's limit the yield generation abilities of REITs. So even in best time, best managed REITs in India with A grade offices cannot create more than 10%, 11%, 12% yield on a consistent basis. So we don't say this is not an investable this is a very, very healthy way of managing that kind of a return with lesser risk. But we believe it should be more a substitute to debt compared to be a substitute to equity. So allocation to REITs is going to be a next big thing in India. That's why we are closely watching it through. But our ability to create alpha as a PMS, we believe REITs is not a right instrument for a asset management firm. For investors, depending on the risk profile, we believe REITs is a right opportunity to have that diversified asset pool and to make that real with relatively lesser risk. But don't treat it as a replacement of equities. It's more of a replacement of debt. Now, if you see, coming to the topic today, which is flex leasing is one area which is basically getting a lot of traction in the last couple of years. So, in short, basically what happens is that if someone is owning an office, they will go to flex leases and they will lease it out to them in the form of whether it is WeWork or office or place like that. And they will go and manage the facility management part and then they will lease out to the people who want to use it. So they are basically mediator between the landowners and the office users. Here, the most beautiful part is that workspace are basically asset light. So they don't own the properties, right? They run on small scale offices, useful for small to mid-sized scale companies, and that's where they eat up the spread between the. So it's a win-win for all three of us in the value chains. Basically, landlord and owner have someone who can manage their property and can manage all the tensions and get the returns. User of offices get managed offices. They don't have to know and negotiate with landowners or possibly go on their agreement and part like that. And the people in the mediator, which are basically flex user, will make the return out of the connecting between the two. So what is the most beautiful part here is that is first of all it is asset light. What the trend which is building up in hotels where they basically take the managed services rather than owning the hotel property and then managing it, they just take the property which is owned by somebody else and they manage that brand, and that is space which is making money in the hotel space. Same kind of thing is happening in this, where the owner is just lending it out and they're making money out of it. So there are two ways to do this. One is co-working, which is basically, if you have heard about WeWork, I think there's a recent IPO which came. That's where a lot of the small offices, they work startup as a small some unit. They are working together, but the asset is managed by the flex, office flex leaser. And another is the managed offices, which is large offices. I think we will go in more detail into them. But this is in short what flex workspace looks like and how it is different from the other commercial real estate. Now let us just quickly compare, the pros and cons of all that we have discussed so far to you also have a summary of that. So we talked about hotels and malls, REITs and cinema when we compare it to flex workspace. So on supply and demand, if you see there is huge demand. So because see what we understand is flex workspace is a big play on GCC today, which is global capability or the development center capability center which is building up. So the demand for offices in the commercial real estate is very very high, and same goes with supply. But if you look at in hotels, we believe that supply, as we spoke to you about the number of rooms which are coming, but and at the same time we have medium demand term because of we have already seen good 4 to 5 years. Mall is a tricky one where both supply and demand are not being very very salubrious from that perspective. REITs is comparatively okay. Cinema is one which is definitely struggling through. Second area is, which I believe is very, very important from commercial real estate is the investment in the gestation period. Obviously, hotel, if you're not doing managed services, the investment upfront is very high and the gestation period is also very high, which hits the return ratio. Similarly, is higher goes for malls. A mall take many 3 to 5 years, and I know the payback period is much, much higher. REITs again is very high, but gestation period is medium because it has been managed more efficiently. And cinema is no different. Again, that the variable factors which helps them to get their gestation period depends on various other factors. So, but if you look at flex workspace, I believe the most beautiful part here is that not only the upfront investment is pretty low because the real estate is not owned by the flex workspace, but even the payback period, you will be surprised, and when Raj will cover it in more detail, in some cases is less than a year. That's why when majority of this other commercial real estate entities where the ROEs is between 8% to 10%, here the ROE is a report of 30-40% if you are able to manage your property well. And then you're able to throw this cash flows and get this higher pad. So you're build in short, you're playing on the commercial real estate growth, right? And at the same time, you're not exposing yourself to undue risk on the capex side. So as you see, look at the ROEs, majority of them between 10, 20 or 8 to 10, but some of them in flex is, even the worst of them is double the size, double the number compared to the best in the other segment there. And if you look at the cyclicity, which is very, very important on this sector, we believe that hotel is the one which is very, very critical. Your in entry and exits are very, very crucial, and same goes for cinema. But in REITs, the cyclical city is well managed because this is basically commercial real estate, and there is always a demand, inherent demand, which is there. Same goes for mall because it's a retail and it's dependent more on consumer sentiments, which is more linked to the economic parlance. But in the flex side, the cyclicity is again similar to your malls and it's very, very low because office space is something which the elasticity of demand is not that movable around, whether the economy is really going at 7% or 4%. So that's what it is. So if you see the comparison, we believe Flex Workspace is clicking all the right boxes. And I think let's spend more time understanding Flex Workspace. Raj has worked intensively on this. He has been author for this report. So let's hear from the horse's mouth. Over to you, Raj, for further details.
Yeah, thank you, Aishwarya. Hi. So my agenda for today is basically covering the various operating models in flex leasing, diving deep into why do we like the flex leasing industry, and then scanning through the competitive landscape to understand which players stand out and which players do we like currently. Coming first to the operating models. So from the clients or the tenants perspective, there are two operating models right now, co-working and managed offices. Co-working, I think we already discussed, these are small scale offices with average seating capacity of less than 100 seats, close to around 50 to 70 seats, which are taken up by startups, SMEs, and small size corporates. While managed offices are large scale offices with average seating capacity of close to 300 to 500 seats, taken up by KPMGs, Google, TCS, Microsofts of the world. These offices, so for in case of managed offices, someone like IndiCube or SmartWorks, they manage the end-to-end office building for someone like Google, with all the housekeeping, mobility, food and beverages, etc. Everything is managed in-house by them. While co-working is for small scale startups who have limited headcount but yet want to gain access to all these amenities in a single building. So currently in India, we have two players focusing on co-working, WeWork and Office. While in managed office, there have been a large influx of players. And because it is easier to get into managed office as a business model, considering that if you have a large anchor client, someone like Google, if he tries to if he you get him as an anchor client with around 800 to 1000 seater capacity, then you can easily get into an agreement with a standalone developer and start a managed office business. While co-working is much more granular, where you have to develop your own distribution model, you have to source clients, have a dedicated sourcing and marketing team. So thus co-working as a business is difficult to build. In terms of revenue per seat, of course, because in co-working, your client size is smaller, they are small scale startups, SMEs, your bargaining power is much higher. So the revenue per seat is much higher. For WeWork, it is close to 18,000 per month. While in the case of IndiCube, which is mainly a managed office player, it is close to 8,000. Now, because of this, the large influx of competition in managed office, the supply has grown at much faster pace, almost close to 25 to 30% CAGR over the last 5 years. And so is the demand. Demand has also been very strong with the influx of GCCs, with large corporates also wanting to move to flex workspaces to remove the hassle of working with different various kinds of suppliers. So the demand for managed office has grown at higher pace compared to co-working, and even in co-working, the number of players have also been slightly lower. But as a business model, in terms of ROCEs, co-working is a slightly better in terms of ROCEs at close to 30%. But of course, it is a difficult business model to build. And once you have developed your own distribution model, then it is a much profitable model. So what do we prefer? We prefer generally a mix of both co-working and managed office, where you get large anchor clients in terms of managed office and the operating leverage of co-working. So mix of both would be a better model. Now, moving on to your second operating model from the landlord's perspective. So from the landlord's perspective, we have two models. One is straight lease, which is your plain vanilla leasing contracts. You lease out a large office space from a landlord, someone like a Lodha, etc., and then you build it out to other corporates, someone like Google, Microsoft, etc. Here, the capex and the fit out cost entirely is being borne by the flex space operator. So capex per seat is roughly around 75,000. While managed aggregation is a slightly different model where and this is mainly undertaken for grade B buildings or for standalone buildings with small developers or small landlords, where you enter into an agreement with the landlord that you would be paying some minimum lease rentals, and the landlord would be able to capture the revenue sharing from higher occupancies. So suppose for a new managed aggregation contract, initially the rentals would be close to 40 to 50% of your total contracted rentals, and as your capacity or your occupancies improve, they'll be able to get a share of revenues from those land as well. So this kind of business model is generally liked by small scale developers who want to get an upside from the flex workspace model as well, and at 80-85% kind of occupancies, managed aggregation as a model is very profitable as compared to straight leasing. But of course, for large offices, large developers would always want to uh, uh, would always prefer straight lease model, because you get contracted cash flows for the 5 to 6 years over the lease term. So straight lease model is which is largely prevalent in the industry, but managed aggregation is largely adopted by grade B flex operators, and here ROCs etc. are much higher. So as such, what we prefer again here a mix of both is much more preferred, because it gives you higher operating leverage and better ROCs in terms of your flex for your flex operators. And we'll see ahead as well that why Office adopts this model and why it has better ROCs. Now, moving on to why do we like flex leasing as an industry? Yeah, so one of the most important reason for liking the flex leasing industry is the strong industry growth. So if you see the Indian commercial office stock, it is growing at roughly 6 to 8% CAGR. I think that would be largely in line with the headcount growth that the IT, BFSI, and consulting industry is seeing, which are the largest three employers in our country. Their headcounts are growing at roughly to 4 to 5% CAGR, and similarly, the Indian commercial office stock is also growing at 6 to 8% CAGR, while the flex leasing industry is growing close to 20 to 25% CAGR. Now, why is it so? Because the clientele for flex leasing is slightly different. In flex leasing, the clients are small scale startups, SMEs, MSMEs, mid corporates, or GCCs and large corporates who want to open a slightly smaller regional sales office, etc. So if you see in this chart, the number of startups that have been recognized in India, they have grown at a CAGR of almost 40% over the last 4 to 5 years. Similarly, the number of unicorns that were registered in India in 2019 were close to 30. That has grown to 150 by the end of CY25. So the growth in the industry has been very strong. And similarly, the growth in flex leasing has also been quite strong. Second, I think Aishwarya has already covered, but because these are back-to-back contracts where you only need to take the upfront capex cost, the fit-out cost, and unlike REITs where you yourself develop the property, take the entire property on your own balance sheet, and thus have a very high upfront capex. The capex in flex leasing is much lower, and thus resultantly your center level ROCs are very high, close to 25 to 30%, and much superior than all other commercial real estate plays. Thirdly, compared to lease, if you see compared to REITs, so in REITs, your clients are mainly IT, BFSI, and consulting companies like KPMG, Deloitte, TCS, Accenture, etc., who have large offices of close to 1,000 to 3,000 employees, and those kind of customers drive 60 to 70% of your rentals. So if was like what we are seeing right now, that IT industry is going into slightly a slowdown phase, and because of that the headcount growth for the IT industry is also muted. So if you're highly concentrated into a particular industry, your growth also gets affected because of that. But in flex leasing, because your top 10 20 clients contribute not more than 10 to 15% of your revenues, the slowdown from one industry can be mitigated by an increasing commercial activity from other industry. So that helps you diversify your revenue and move into an industry which is currently witnessing higher growth as compared to other industries. Yeah. Now moving on to another key advantage of the flex leasing industry is the high industry concentration. So if you see the other various commercial real estate plays like hotels or cinemas or malls, etc., there are a large number of players in the industry, and top 4 or 5 players do not make more than 15 to 20% of the industry capacity. While in flex leasing, the top 4 or 5 players are almost at 85% of the capacity. So what it does is that first it makes the barriers to entry higher, so it is difficult to enter into this industry. And second, you get, once you are a decent scale, the operating leverage for them is much higher. So operating leverage for someone like Office or SmartWorks, when they sit with across clients for leasing out spaces, is much higher, because they get in terms of fit out cost, in terms of other capex, in terms of housekeeping charges, etc. Uh, they are able to save a lot of cost while leasing out these services. And similarly, but someone like a new entrant in this industry, like Coworks or B Workspace, etc., these players, of course, their unit economics are slightly lower, so they have to charge slightly higher. So larger clients may shift their business from the smaller flex space operators to these larger companies, and this industry concentration is actually playing in that favor. So if you see the top 4 or 5 top 4 or 5 players concentration was close to 65-70%. I think 3 to 4 years back, that has now increased to close to 85%. Now the last and the most important, I think, advantage of flex leasing is the focus on both tier 1 and tier 2. While tier 1 industry is growing at 20-25% CAGR over the last 4 or 5 years, tier 2 is where I think the next phase of growth from flex leasing is going to come. Because what is happening, that a lot of GCCs or lot of large corporates are now shifting their regional offices, or are now trying to shift their office culture from work to office to slightly hybrid mode. So a lot of people are now shifting their main head offices from tier 1 cities to tier 2 cities, because your lease rentals are lower, even your talent cost is lower, and you can and employees can work in a hybrid work environment, where they can come to office for a few days and work from home for a couple of days. So that kind of model is leading to a huge growth in tier 2 cities. It has grown over almost 9x over the last 6 years, and it is expected to grow at 40-45% CAGR going forward. So as such, flex leasing, I think, is a very strong play on the tier 1 industry. Of course, that is growing at 20-21% tier 1 cities, but it is a very good play on tier 2 as well, tier 2 cities as well. Now, yeah, so having discussed this, now let's, I think, browse through the competitive landscape of this industry. So if you see, as we discussed, Office is the only player that is currently focusing on managed aggregation model. All the rest 3 players are focusing on straight leases. Of course, SmartWorks and IndiQ, because they are 100% managed office players, where they lease out large office spaces of close to 800 to 1,000 seats to large corporates. The real estate developers would always prefer straight leases from them, while WeWork as a business model both in India and globally has only adopted straight leases. So Office is the only player who works with grade B developers and has the capability to source supply in managed aggregation format, which is much more profitable. In terms of co-working, we discussed, I think Office and WeWork are the only 2 players focusing on co-working. Rest all the players are mainly focused on managed offices. While this as a model is, I think, growing much faster, but I think as more and more as the demand for co-working and flex office in India picks up, I think co-working as a business model will be much more profitable. Client concentration, again, I think we already discussed, is quite low for almost all the players, I think, which works in your benefit. Your bargaining power also increases, and you are also immune to any specific industry shocks. Center sizes are much lower for office, and mainly because they work with small size corporates, MSMEs, and if you see number of centers, they are almost 4 to 5 times of these other 3 to 4 other three players, that is SmartWorks, IndiCube, because they try to get small size centers and then lease out to small scale startups, MSMEs. They give seating capacity of as low as 10 to 15 seats. So because of that, the center size for office is much lower. Now coming to the geographical mix, if you see, office has the highest geographical diversification. No particular city or micro market contributes to more than 20% of revenues for them. While IndiCube is highly concentrated in the Bangalore region, SmartWorks mainly into Bangalore and Pune. We work again into Bangalore because, of course, Bangalore is the hub of IT consulting and startups. So, naturally, the concentration or the penetration of flex leasing is the highest in the Bangalore market. But except apart from that, office appears to be the most geographically diversified across different micro markets and regions. So overcapacity or muted demand in any particular micro market, I think they are the best ones to show across that kind of industry phenomenon, where if a particular micro market is not doing that well, they can put up incremental capacity in a newer market. Now, in terms of occupancy, of course, office and WeWork will be slightly lower because it is much harder to find new. It is slightly tough to find new demand, or you have to have a very good distribution network because your clients are small scale startups, etc. While for IndiCube SmartWorks, you have large corporates with more than 800 to 1,000 seats. So because of that, the optically the occupancy for office and WeWork looks slightly lower at 75%. But even at such lower occupancies, the margins for WeWork and margins for WeWork and office are much higher as compared to your SmartWorks and IndiCube. So lower occupancies, so they break even much at a much lower occupancy of close to 40-45% versus SmartWorks and IndiCube that break even at around 60-65%. So at 75% even, they are very profitable as compared to the other two players. Yeah. So now, why we like office in particular among the different other listed flex leasing operators? Why do we like particularly office and IndiCube? I think 2-3 main reasons are that they are the fastest growing in the industry. They are highly diversified in terms of their geographical mix, their client mix, and they focus more on managed aggregation and co-working, which we believe is a much more profitable business as compared to large scale managed offices. As competition also increases in the managed office and the flex leasing industry, what will happen is that to source new supply, you will have to spend more and more in terms of brokerages to get new clients. While for office, they have their own internal sourcing and marketing team of close to around 150 to 200 people, and 65 to 70% of the supply is insourced. Versus for someone like SmartWorks or IndiCube, which have 85 to 90% of their sourcing done from through brokers. And because of the increasing competition, the average brokerage that is being paid to these brokers for sourcing new supply, which was earlier at close to 1.5 months, now has gone up to as high as 3 months. So this increasing brokerage cost will again result in a reverse auction on your revenue per seat and capex per seat. So we think that overall having your internal sourcing team, having lower brokerages and focusing more on granular supply and demand, I think is a much better business model. In terms of valuation as well, if you see, office is, I think, amongst the cheapest among the other 3-4 listed players. I think we understand that over the last 2 quarters, I think office as a stock has not done that well because last quarter also there were quite a few one-offs, so their PAT growth was slightly muted. But I think this business has to be seen over a long-term perspective. They are doing a lot of investment in terms of opening new elite centers. Elite centers are basically having higher, they have higher revenue per seat as compared to your standard centers. They are focusing more on increasing the revenue from ancillary services like mobility, food and beverages, from design and build, where you design the entire furniture fixtures for your clients. So as a business, 1 or 2 quarters, I think the EBITDA growth or the pre-Ind AS or EBITDA growth as compared to the other 2 3 players might be muted because the visibility for someone like IndiCube or SmartWorks for the near term is higher as compared to office. So you might get some seasonal fluctuations, but that is a good opportunity to invest or to enter into a stock at a reasonable price. So overall, over a medium to long term, I think co-working as a business model and office as a player should outdo other players in the industry is what we believe. So yeah, just to summarize, I think flex leasing as an industry has seen phenomenal growth over the last 4 5 years. That should continue. The penetration of GCCs and the rise of small scale startups, etc., bodes quite well for the industry. The business model is largely asset light with high ROCs. The churn rates for the industry are close to around 1.5% for per month, which is also quite low, and customer concentration as compared to REITs is much lower. So as such, if you compare with among the various commercial real estate plays, flex leasing appears to be one of the better industries, and amongst them we prefer office. So that is it. Happy to take any particular questions on any player or any particular industry. Would be happy to answer your questions. Thank you.
Thanks so much, Aishwarya and Raj, for this detailed insight on co-working spaces as well as why we like the space vis-a-vis the other commercial real estate plays. We'll just take a minute and I would request everybody to post your questions and we'll take them one by one. And while we assemble the queue, let me preempt one of the questions and pose this to Aishwarya in the interest of time. I think in terms of broader markets, as a house, Aishwarya, if you would want to give a quick summary on how we are seeing markets at this point in time.
Yeah, hi, Bhavin. I think that's $1 million question. We have a tough time in the market over the last, I would say, 15, 16 months. But now we are going constructively positive on the market. I believe there are certain things which is playing out beautifully for the Indian macro in the last 6, 8 months. If you see the three most important pillars in front of you, first, obviously, government. I think government and RBI has done everything possible in their hands to make sure that both the economy and the growth keep roaring. So if you see, we obviously saw GST rationalization, that I believe one of the biggest reform and which will have far-reaching impact on the economy and the market going ahead. And when we added the income tax cut, which happened a couple of months back, and the continuous government capex, I think the ingredients are put in just in the right proportion. And on top of it, we have RBI who has been pretty aggressive in repo rate cut and the most unexpected CRR cut which happened. And we are running on liquidity of almost 2 lakh crore continuously over the last 5 6 months, which is visible in the festive season and the growth. So I think both RBI and government are doing things for the economy to work in wonder. And that's why if you see the corporate profitability of India of listed space is, if I say the listed companies PAT compared to the GDP is almost at 5.2%. If we add the unlisted part, I think that number is going close to 7.8% of the GDP. Comparatively, US is around 11%. But any economy which has been above 8% for consistent time period, see the good kind of impact which is playing out. So we obviously have good earning revival, which we'll talk about it, and the recovery, and being added by strong balance sheet. So all the ingredients are in place. Now, if you remember last time when we discussed, we said the issues were more local than global. This time around, things has reversed. So now issues are more global than local. In India, we have seen good monsoon, very strong festive season, good consumer sentiment. In spite of 50% tariff, export growth has been 7% in September, where we had full 50% impact In spite of huge cut in GST, GST is still grown up 3%. Bank credit growth coming back to 11.5%. Inflation around 1.5%. CPI vegetables is almost negative, giving the leg room for RBI to play around on liquidity and cuts. Uh, Crude has been a blessing for India over the last 1.5 year. So all these things are coming at the same time. It's making a pot probably that FI, which has been selling India continuously. If you look at July, August, September, there was an average 42,000 crore of selling which happened. There is a fatigue which is setting in from FI selling. So just in October, we saw hardly there was a flattish number. This month, so far, we are seeing a couple of days of big selling, but majority of the days we are seeing intermittent buying. So there's a fatigue which is visible from FIs. There is expected to have some tariff-related concern, but I think the worst is behind us. And most importantly, the valuation. We used to be at 150% of GDP, market cap to GDP. That number has gone to almost 135 as we speak. Valuation forward is close to less than 21, which was almost 22 and a half or 23. So we're not saying India is cheap, but a lot of the segments, sectors, there's a lot of fraud which was there into the system has been taken care of. Area of concern which can derail the market movement obviously is one is the fiscal side. If you see the H1 where the government has done almost 40% higher capex growth, we are not seeing that kind of momentum picking in direct tax and indirect tax. 6 month FY26, the first half direct tax growth is almost 3%. Corporate tax growth is 1%. Indirect tax also similar to 2.8%, led by GST cuts and all that. So we might see some sort of fiscal slippages might happen if this is an investment or possibly, some non-important capex is not cut. So it will be very interesting to watch going ahead. Second area is private capex. In spite of huge government capex, is still not rolling in. But we believe these are manageable issues. I see the most important part which will relay the market from here onward, if you see, is how our quarter has panned out. If you see the next slide on macro, I think this was a catalyst or a turning point of the quarter results, which has led to a kind of a stop for FI selling and the kind of market movement we witnessed in October and so far in November. You will be surprised to know that if you see the last 6 months or the last 1 year, midcap 150, which is the company, midcap companies, has actually outperformed Nifty and BSE 500 hands down in the last month. So it tells a lot about the markets heading toward more of a risk on sentiment rather than that. And I think that is more to do with a very healthy number which we witnessed in quarterly season. Most likely the demand commentary from many of these managements is indicating more bullishness. So we should be able to do more kind of a 10-15% growth in the later part of second half, eventually doing 10% growth in FY26 compared to 5%. So we are out of this earning cut cycle. And obviously on top of it, we saw what happened in Bihar, and we also witnessed that if you see the last 10 days or so, there has been a lot of pressure on the global market where India is standing still. So possibly India could be a play going ahead, which would be a defensive story in this whole AI saga. So if you really look at, we have highlighted you on the numbers, how the numbers has panned out, and we believe we are at the inflection point from where we might see not only the broader market but large cap and especially the small cap which is lagging behind to participate meaningfully in the coming month, Bhavin. So this is what we believe. Why are we constructive on the market going ahead?
Sure. Thanks. Thanks so much for that, Aishwarya. Good to see questions pouring in. So let me quickly take them one by one and address that to the team. Firstly, I think Raj, maybe you can take this. Very interesting question saying, why can't real estate companies or even REITs manage office spaces directly, and why is there a right to win for co-working spaces?
Yeah, so if you see the business model of a REIT or a real estate company is quite different as compared to a flex operator, because the upfront capex for a REIT or a for a real estate company is so high, or for them to enter into this flex leasing industry and to rent it out to individual developers would not make much sense. Their focus is on more to take on the assets on their balance sheet and earn steady cash flows. even if they enter into this industry, incremental revenue or incremental profitability would not be higher. It would just make sense for them to give the building or any commercial property to a flex operator, who in turn then can work with individual clients. So it would, for them, for REITs and for real estate developers, it would not be much profitable to enter into an hassle of working with individual one-to-one clients when you have already taken such high upfront capex on your balance sheet.
So just to add one point, one thing we have to understand between a real estate developer and flexi lease space, one thing which differentiate between the two is the flexibility, right? So even if a developer is thinking, okay, this flex space, people are renting out space for say 12 to 15,000 a seat, right? Why don't I, being a creator, take that? We have to understand out of this 15,000, 2 to 3,000 will go for your fit outs and things like that. But there is a kind of operational hassle. There is a dynamism, there is a play on occupancy, there is a play on pricing. There's a lot of small bits which really makes them work through to become successful. So there's a lot of variable which plays through. That dynamism is completely different business model, and which will really not move the needle for a large state real estate developer to come to that particular space. So I don't think anyone has even tried to do that in that space, and even if they do, there's a lot of time and energy which will go, which will not be very remunerative.
Thanks so much. Let me quickly move to a couple of questions on Office. So firstly, how well is Office funded currently? How are the cash flows looking? Raj, if you want to just quickly cover that.
No, I think post IPO, what we have heard from the management is that I think they have enough, because the operating cash flows are so strong. You get upfront revenue from your tenants, and your rental payments are either quarterly or semi-annually. So your EBITDA to cash flow conversion is almost above 100%. So incrementally, for incremental growth, for growing close to 25 to 30%, which they have been doing over the last 2 to 3 years, I don't think so they'll require any incremental capital. Internal funds would be enough for at least for the next 2 to 3 years.
Great. And I think we have another query on Office, so maybe we'll club that. Their average revenue per seat is 15,000. So a very interesting question saying if you are running a 10-member team, the average outgo is 1.5 lakhs. Whereas if you were to directly lease the office, you may get it, about 20-30% cheaper at about 90,000 to a lakh. So what are the value adds? And Raju covered that, but maybe we can reiterate that. Why would smaller setups look to use Office and not set up their own rental arrangements?
Yeah, so I think the main reason would be the softer nuances, right? If you are a 10-15 member team, but yet you want to avail the facilities or services of a large corporate enjoys, something like mobility services for your employees, food and beverage services, or housekeeping services, meeting rooms, etc. All of that would not be possible if you just rent out a single standalone building from a small developer or in a grade B building. Secondly, everyone knows that working with landlords in India is very difficult. So if you do all the capex upfront on your own books, and then if a landlord asks you to move out in 2 to 3 years post you moving in, I think the capital investment from your side can be significantly higher versus if you directly work with a flex leasing operator and you just pay out your yearly rents. They take care of all the seating and fit out capex. They take care of the hassle with the landlords. They take care of all the ancillary services that they can provide to you under one umbrella. So all of these softer nuances are the reason why startups are actually preferring flex leasing rather than slightly saving some money upfront, but then not getting all these services, etc.
Thanks, Raj. Maybe I'll move to the next question very quickly, and I think we are at the fag end. Uh, Maybe again we can spend a minute or two because there's a question on managed aggregation. Maybe if you could cover that again.
Yeah. So again, managed question is basically
We can
what
go to that
yeah, we can go to
Sure.
presentation slide also.
no. Yeah, correct. So managed aggregation. So in managed aggregation, what happens is that suppose I'm a individual standalone real estate developer and I have a single operating building. Now rather than and because my bargaining power is low, so suppose I lease out to some a flex leasing operator where I charge upfront 7 to 8% of rental cost in terms of a fixed monthly rent. What happens in a straight leasing model? The Because the bargaining power of the flex leasing operator is much higher, or the or the tenant is much higher, the my payoff or my ROCs will be much lower at 7 to 8%. So what is happening that instead of doing that, what I can do is that I can enter into a rent sharing or revenue sharing agreement with your flex leasing operator, that up to 50% occupancy or up to a slated occupancy, I'll charge you minimum guaranteed rent, and above that I get a share of revenue from the flex leasing operator. So suppose your occupancies cross about 80-85%. What we have historically seen and what the management of office has also said, that the payoff for landlords increases by 2 to 3%. So if they are yielding close to 8% in a straight leasing model, because of this revenue sharing agreement of close to 50-50, the payoff for the landlords in good micro markets and even in tier 2 cities, in the heart of the cities, the payoff for landlords is as high as 11 to 12%. So for that incremental 3 to 4%, they enter into these agreements, and from the flex operator, it is a win-win that they don't have to spend much in terms of upfront capex. And of course the margins will be slightly lower, but of course your ROCs are much higher at 35 to 40%, because your initial investment is co-funded by your landlord.
Thanks so much, Raj, for that. I think we are at the end of the Q&A session as well as out of time. So I'll just conclude by again thanking the audience for joining on call and for your questions. I hope you found the call useful, and we'll keep building on these and sharing updates on our funds on a periodic basis. Thank you so much.
Thank
Thank
you
you
so
very
much.
much.